Hi, this is Sandra, your private funds AI assistant from SmartEsq. Here is a briefing on what I learned this week on private funds. First, in what could be the most significant corporate governance shift in decades, SEC Chairman Paul Atkins outlined a pathway for companies to exclude most shareholder proposals. Speaking on October 9th, Atkins signaled that SEC staff would grant broad no-action letter relief to Delaware companies looking to exclude proposals under Rule 14a-8. The theory hinges on the non-binding nature of most shareholder proposals, arguing Delaware law doesn't permit them. Since proposals governed by Rule 14a-8 are almost always non-binding, this affects a broad range of shareholder proposals, from ESG issues to governance and compensation. The implications are profound. While shareholder proposals historically shaped modern governance, removing this pressure valve may redirect discontent toward director elections and say-on-pay votes. Activists may shift toward binding vote proxy contests rather than advisory proposals. Second, on September 30th, New York's Department of Financial Services issued new guidance on how institutions must custody cryptocurrency and other digital assets. The guidance has 4 key requirements. First, customer crypto must be completely separated from the firm's own holdings, no mixing whatsoever. Second, you can only use customer assets for safekeeping, not for lending them out or generating yield for your own benefit. Third, if you want to use a third-party sub-custodian, you need thorough due diligence, and you must get New York's approval first. And fourth, you must clearly disclose to customers exactly how their assets are being held and what risks are involved. This is especially important if you have New York investors or use New York regulated custodians, because these aren't suggestions, they're enforceable requirements. Third, on October 1st, California's Air Resources Board released a draft list of 4,159 companies, subjecting them to the state's new climate disclosure laws. Here's the structure. Companies doing business in California with revenues over $500 million must report climate-related financial risks starting January 2026. Those over $1 billion must disclose Scope 1 and 2 greenhouse gas emissions by June 2026, with Scope 3 supply chain emissions following in 2027. The timing is significant. With the SEC having withdrawn its federal climate rule, California has effectively become the national standard setter. The ambiguity around doing business in California adds uncertainty. Does it require physical presence, revenue thresholds, or something else? For private equity sponsors, this impacts the entire investment lifecycle. During acquisitions, assess whether targets have systems for emissions tracking and climate risk assessment. If not, that's a quantifiable post-closing cost for consultants, software, and personnel. Our final story involves event contracts tied to sports outcomes. They are derivatives that allow positions on whether specific sporting events will occur, like championship wins or game scores exceeding thresholds. These aren't traditional sports betting. They're structured as regulated futures on CFTC-registered exchanges. But in early October, the CFTC issued Advisory 25-36 with a stark warning. Just because these trade on federally regulated exchanges doesn't mean they're legal everywhere. The Commodity Exchange Act may not preempt state gambling laws. State attorneys general are already sending cease and desist letters, and a recent federal court ruled state gambling laws aren't preempted. This creates fundamental legal risk. If a state regulator determines these contracts violate anti-gambling laws, exchanges may be forced to immediately liquidate all open positions to avoid violating state law. That's it for this week. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartsq.ai.